Welcome back. You're watching Stockwatch with me, Simon Brown. Joining me to take stock-related questions tonight, Willem from Nitrogen Fund Managers and Rowan Williams, also from Nitrogen Fund Managers. Please be sure, send your questions, email at stockwatch@bdtv.co.za or via SMS 41392 or on X using hashtag Stockwatch. Gents, appreciate the time today. Welcome to you both. Rowan, let's start with you. We're going to come to PGMs. We're going to talk a lot about PGMs because the inbox is full. But I want to start with Barloworld, who had rallied quite hard in the back of a sense announcement earlier in the year. Maybe there was, and then Friday afternoon, they're cooperating with US authorities. They have essentially gone to the authorities where they might have breached sanctions with Russia. Left the market, A, little bit spooked, but also B, just unsure what this means.
Yeah, it was something of a surprise. I mean, what we have seen is that they've renewed a cautionary twice, and market speculation is that it's a Saudi-based cat distributor that is interested in acquiring them. So the share has been trading at a premium with a bid premium in the price, and this came, I guess, out of the blue to some extent. They've indicated they still have the Russian operations, but they are winding it down and possibly only supplying parts. So the fact that they've been potentially dodging sanctions with Caterpillar suppliers through that division is quite concerning. And I think the reason for the outsized market reaction really has been because there's been this bid premium and concerns that this would stymie the transaction. And so you saw a massive share price reaction on the day. It has recovered somewhat, but is around or just close to 80 Rand at the moment. So that is more to levels prior, I guess, to the bid or the cautionary. And so I guess the market's sort of putting even bets that this deal is on or off at the moment.
Willem, does that leave us almost in a space? Because my follow-up question would normally be, is Barloworld a good stock? Does this almost leave us in a just too much uncertainty and rather wait and see? Or is this something where you might think there's opportunity?
Well, I think in recent times we've had quite a few transactions that haven't gone through. So any sort of uncertainty gets punished very aggressively by the market. And Barloworld, even though there wasn't an offer, there was definitely pricing in the share price for a potential offer. And I mean, all of that was speculative. So whether or not it's a good share, yes, definitely. But a buyout provides you with a liquidity premium, which in the market you would not get. So the reaction would be very fair on Friday.
Yeah, I take your point. We just now don't know. And if that deal doesn't happen, we've seen it happen with Bale Equipment last week. Your share price very quickly gets taken out. A question that came to me on Twitter early in the day, talking around healthcare stocks generally on South Africa, but the hospital groups, which is Life, which is Netcare. Willem, let's stay with you a sec. Healthcare space that you like? Have you got a preference or not much a space you're really into?
I think Life Healthcare is a good pick. I think in the overall space, what's very positive is the president's stance on the NHI. And even though it might be sort of more rumors or just speculation, there's a chance that the aggressive stance on the NHI is wavering with the GNU. And that would be incredibly positive for medical insurers, for hospital groups. But in this space, Life Healthcare makes the most sense for us as a company.
Rowan, what if we brought in Aspen? Because they had some numbers out, I think it was 2 weeks back. Market did not like. I remember at the time David Shapiro was saying they've got to get their capacity at their Gqeberha plant up and going. If we step further out, does Aspen come into play, or is Life Health really the one?
Yeah, so I think Aspen's more exposed to overall generic manufacturing and, as you said, the ability to fill their significant manufacturing capacity both in South Africa and in France. So it's much more about demand of the pharmaceuticals that they provide. In terms of playing, South African healthcare space, definitely the local hospital groups are the way to play it. They both have been hit quite hard in the lead up to sort of NHI and the promulgation of the Act. And now that the stance is softening, certainly the market's warming to them. I think post-COVID, their margin recovery hasn't been that fantastic. That's been somewhat disappointing and underwhelming, but they're seeming to get their costs under control. It does look like demand is slowly improving, albeit at slightly lower margins. They're having to do some network deals. But at these levels, and we've seen the rest of the market, particularly SA Inc., rally quite significantly, they are looking fairly reasonable, sort of 20% discount to their long-term ratings.
Let's move to Pick and Pay. It comes up quite repeatedly. Rowan, let's stay on you for a moment. Shoprite is the giant in the grocery retail space in South Africa. Pick and Pay is the hopeful recovery story. Your take on Pick and Pay? The rights issue, well subscribed. Sean Summers, probably the right person. Boxer IPO coming. Is there opportunity in Pick and Pay in the hope that Sean Summers gets it right?
It appears that the core Pick and Pay business is badly broken and is taking a long time to fix. I think Sean Summers, as you mentioned, is the right person. He's very realistic about the prospects for the core stores and what needs to be done. So I think the market liked that realism, and then it's going to take 2 to 3 years to turn them around. They're going to have to trim the store base considerably. But that's not an exciting story. It's just that they're stopping the bleeding. Really, where the value lies is in Boxer and the potential listing of that, which is coming later. We have seen a lot of analyst reports saying rather wait and buy Boxer than participate in Pick and Pay here, because, as you say, Shoprite has really been the big gorilla in that space and has dominated and is using, you can see with the margins, they've been putting the savings from the load shedding into margins in the form of discounts and gross margins. So it's a very competitive space, and I think they're trying to squeeze Pick and Pay when they're down, and they will continue to do so. So I wouldn't pick up the weak competitor. I'd rather play the strong player in that space, which would be Shoprite over Pick and Pay.
Willem, and then the thing is, Boxer, as a Pick and Pay shareholder, you're going to lose a big slice of Boxer as they do the IPO. To Rowan's point, you know, you're losing some of the crown jewels in the process. And also importantly, and it's to the question, it's going to be an IPO, so this isn't an unbundling, so you're going to have to subscribe to it. So as a Pick and Pay shareholder, I mean, the debt will be lower, but you've lost some crown jewel.
Yeah, 100%. It's diluted. So I think as Rowan mentioned, we don't really like the Pick and Pay sort of legacy superstore business. So the way to play that would be to participate in the Boxer IPO and get exposure purely to Boxer rather than Pick and Pay, which would have some exposure to the Boxer stake through ownership. So I think that is by far the better way to have exposure to that group as it's listed at the moment.
Question came through again on my Twitter earlier this morning around Metrofile. We had results out. A stock I used to long hold because I like the idea, I like the dividend. The idea's become weak, the dividends faded away. I don't know if either of you had a look at results and have thoughts on it. It has been tough. And I mean, I don't know, they store paper in a zero GDP growth economy.
Yeah, I had a quick look at it, and as you say, it was a nice, neat, small cap business. They had high return on capital, good cash flow. They sort of had steady growth. But I think what's happened is the market's starting to leave them behind. I mean, as you say, storing paper records sounds like a bit of a sunset business. Obviously, the world's moving digital, and a lot of information is now stored digitally, backed up digitally. And so soft demand, as you mentioned, in a tough economic environment and having a big impact on their margins. So a bit of a fall from grace. So, and yeah, nothing to get excited about even at these levels.
Yeah, no, I take your point. It actually once was a bankrupt business 20 years ago, then it became unbankrupt, and now it's just, as you say, a sunset business. Willem, if we come to you, a question coming through around construction stocks, but construction stocks with SA focus, which of course means, well, I mean, Avengers out the window, Wilson Bailey's got a bit. I mean, is it Steph Stocks has got a bit, or is it just always Rabex?
I think Rabex is probably a good play in the space, but genuinely construction South Africa has been a very poor performer. Over the last 5 to 10 years, there's been very little positive from it. So if you've got a very positive outlook on the GNU and maybe some sort of capital infrastructure spend that would sort of lure investments into the segment. But overall, I don't think those stocks perform, and they're very capital intensive and generally at a sort of a below cash return to the investor. So I can't really give an overly positive review on any of the sort of listed South African construction companies.
Rowan, our president talked around turning South Africa into a construction site. It's not a new phrase, and once it was, back in sort of World Cup-ish time, which is a way back. What about then Afrimat in that space? I mean, they've really changed. They've still got the aggregate business. They've got the construction materials. Andres, I mean, that construction materials, I think, doubled in the last financial year. They've now got Lafarge. Does Afrimat perhaps a better option almost in a sense because they're selling the picks and shovels?
Absolutely. I would think you'd look for suppliers that are going to benefit from the increased economic activity and construction activity. So certainly Afrimat is one of those. And they did, as you mentioned, pick up Lafarge, which is a bit of a turnaround situation. They've got a great track record, Afrimat, at turning around marginal operations, particularly in that sort of quarrying, industrial material space. So I would back them to do that, and they certainly would be a beneficiary. You briefly mentioned Bell. They would also potentially benefit as there was an increase in demand for yellow metal. So they may be also a supplier that could benefit going into growth in that space.
Of course, I hadn't thought about them, and the stock's coming down now that the deal's out of the way. Willem, we had Oceana out with a trading update today. They gave a lot of sort of broader strokes, wind in the Gulf and other such stories. I always intuitively like the idea about fishing stocks, but they always end up like chicken stocks, very volatile and tough to play. Is Oceana one worth having a look at, or perhaps it's a Sea Harvest or even a Premier Fishing? I mean, is it a sector that piques your interest?
Yeah, so I had a look at Oceana this morning. It is exactly as you described. It's so volatile. I mean, South Africa wasn't great. Some of the US sort of fish oils and fish meal did okay, but then there was some sort of storm activity in the Gulf of Mexico, so that business doesn't perform. So even though this morning doesn't give you any sort of color on headline earnings guidance, sort of earnings guidance, it's very mixed, which means that an investor, it just creates uncertainty, which counts for the entire sector. So I don't think they trade badly. I looked quickly at Oceana at this morning, just in valuation. I mean, it yields 67%. It's not an onerous sort of price to earnings multiple, but the volatility offsets a lot of the positives in terms of sort of value. So they're fairly valued, and I think in terms of sort of basic food production, the growth story is not that exciting. These businesses are fairly mature, and the levers to pull are small, coupled with some volatility in weather and specifically markets for the products they sell. That it's a difficult sort of growth investment. It's sort of a good portfolio build or value investment, but I don't think there's sort of any immediate upside or catalysts for those sort of stocks in the near term.
Yeah, that's a great point. You take the dividend, but don't expect much from share price, except some volatility over time. Gents, I said we had to get to PGMs. A ton of questions. The first one is, why was Anglo Platinum lagging last week? Rowan, is that just the fact that Anglo American still has 73% that they want to send to market, and it's going to lag until that's over?
Yeah, so in the short term, they did Anglo American actually as part of that process that they've indicated the restructuring where they're going to be unbundling that entire stake is they actually placed about 5% of the company with the market. And that, because it was such a large percentage of the company, also a large percentage of the free float, is they had to place it at a substantial discount to the then spot price. And it was in the right region of 7 billion Rand. So that obviously creates a significant overhang in the short term as investors would pick up the share at a sort of 9% discount. And obviously, as the share price recovers, a lot of short-term investors or traders are taking their profits, and that keeps a lid on it. This happened, I guess, at the same time when the rest of the platinum stocks started to rally, and that seemed to be partly driven, at least, by the Sibanye-Stillwater results, where Stillwater indicated they're going to cut some palladium production. So that, I think, it was just the timing. I don't know if it was intended or just unfortunate, and it's created sort of relative value mismatch in the short term on Anglo Plats.
Willem, PGMs had an epic Thursday and Friday. I've looked at the white metal charts. They're still within their range. They haven't broken out in what they've been doing in about the last 3 years or so. Is this looking to you like a sector that one should be interested in, should be having a look at, or is it still just too early to tell?
Well, I think no. I don't think it's a sector to look at. I think the share prices are very speculative, and the production is very marginal. The cut rate mentioned was 200,000 ounces. of market, it's really at the margin. And if you look at the rally in the metals, they rallied, like you say, 17% palladium, 10% for platinum. But those are completely within ranges. And worse even is most platinum producers, all-in sustaining costs are above the spot prices, regardless of the fact that they've rallied 10 to 17%. So these companies are not cash generative, or if they are, it's very at the margin. It's not driven by platinum and palladium. It's generally driven by the chrome in the basket and the gold in the basket, which are profit making or revenue making, which is sort of keeping the companies afloat and alive. So in terms of the sort of excess speculation, I can't see that makes any sense. And the rally in platinum prices, the stocks amplify that due to operating leverage, and the rally in the platinum price is already amplified. I mean, it's a small cut in one metal's global production, coupled with potential sort of US rate cuts, which has driven a 70% move in platinum prices and larger moves in some of the stocks. But this has happened 2 or 3 times this year, and every time it's sort of fizzled out again.
And I got to say, when we're talking PGM miners, when they're talking about their gold and their chrome, then they've got a problem. They should be talking around their PGMs. Rowan, I'm imagining you're broadly in line with it. I mean, we could debate which is the better, but right now it just to me looks like a sector that's best left on the sidelines.
Yeah, I would agree with that. So, and also platinum, gold has its own sort of luster and a store of value that investors like, and even central banks like, where platinum is more of an industrial metal. And also some of the demand drivers for platinum in auto catalysts, we're seeing motor manufacturers cutting production and production low. So that's a very complicated space. There's more metal going into recycling as well. So the demand drivers are not good. And we think, yeah, the price movement's speculative and will come down. And I guess obviously we'll see probably the plat miners, the stocks come down with the physical.
Rowan, let's stay with you a moment. Gold, the gold futures gold at all-time highs. The futures through 2,600 earlier this morning. Is gold still a space to be looking for? And I've got a particular question if DRD's the pick. But is gold a sector you like? Would DRD be one of them?
Yeah, so gold has, I guess, surprised to the upside where, you know, there's been talk about crypto and alternative assets as a store of value, but gold has just retained its interest. And as rates are coming down, so actually gold is sort of gathering further interest because the opportunity cost of holding it actually comes down. So it's been very resilient at the high interest rates. Normally at high inflation and high interest rates, gold would actually lose value, and it's retained value. So good hedge against, I guess, dollar depreciation, which we expect given the cuts in interest rates. So if you like gold, and some people do and some people don't, I think it is still a good play. And those South African more marginal miners, because of the very high gold price and lower operating costs, may do really well. So DRD may be one of the interesting ones. It's got quite a few moving parts, but if they get their sort of operations right and the recoveries right, they will do particularly well.
Willem, if we look across the gold sector, DRD, Goldfields, Harmony, Anglo Gold, Ashanti, Pan-African, of course, as well, what would be your pick, assuming someone liked gold and thought there was still a good story there?
So I don't particularly like gold miners in general, but what I can do is give you sort of a summary of the shaping. So Anglo Gold would be your lowest cost, highest quality producer, and sort of Harmony would be on the right opposite side, and things like DRD and Pan even worse. So if you have a very high target price for gold, you would invest in a Harmony or a DRD. But if you have just sort of an outlook or maybe a portfolio diversify or protection view on gold, you'd look at something like an Anglo Gold, which means if gold prices were to come down, they would still be cash generative at a price closer to $1,500, $1,200, whereas some of the marginal miners, like Rowan mentioned, like a DRD, or even to some degree a Harmony, would only perform in a very strong gold environment. My personal view on gold is just that if you want exposure to it, there are so many gold ETFs, why take the risk of investing in a management team? If you invested in Anglo, now you've got to deal with sentiment. If you invest in DRD and they don't follow through on the difficult projects, then you take downside risk. So if you want the portfolio diversifier, which gold generally sort of tends to be in a portfolio, it's much easier to buy an ETF, which is listed on almost every major exchange globally.
Would that be a GLD ETF or a gold miners ETF?
No, a GLD ETF, so commodity exposure, not company exposure.
Yeah, no, 100%, and remove management from the process. And I mean, GLD's had a great year as well, and if you've bought it locally, the rand's taken a bit of a shiner. But Willem, I want to stay with you. Rate cuts expected Wednesday from FOMC, Thursday from our own central bank. It's going to be a quarter or a half. I don't know which. We don't have to speculate on that. But with looming rate cuts in the beginning of the cutting cycle, again, it might be shallow, it might not. I mean, are there particular sectors on the JSE that suddenly become interesting? Or is this a case of, yes, but this was sort of January, February, March places to be? I'm thinking the likes of the clothing retailers and the like.
Yeah, so I think rate cuts generally favor long duration assets. So that's something to take into account. And then you have to take into account certain sectors. So you'd probably be, sorry, I'm just going to let these stop.
Rowan, let's pick up with you then. I mean, if we're looking at rate cuts coming, what are the sort of sectors that you would be giving thought to?
So it's interesting. Yeah, I've made a point last week that those long duration assets like the major tech stocks, the Magnificent Seven, they've just been a beneficiary of AI hype. And what you're going to see at these levels as rates come down, we'll probably see some rotation out of those stocks and into more defensive cyclical stocks and also consumer staples. So a lot of people have been talking that consumer staples have taken quite a significant hit in the current environment. So obviously, inflation's been high, but they're at a good level. So rotate out of, I guess, those high-tech winners of the AI hype and into sectors that are a bit beaten down, which include consumer staples.
And then what about, staying with you, Rowan, what about the likes of REITs? Because if I'm looking for yield, I could certainly go and buy all sorts of government bonds and get nice, very low risk yield. That's now going to start to fade away. Not a direct relationship, but it'll start to fade away. It's started happening already. Do REITs start to find some flavor? They're not as low a risk, but they are a yielding asset.
So I think what happened with the REITs is our view is they've anticipated a lot of the rate cuts. So this rate cut, I think, has been anticipated for some time. September, there's been now a speculation where it's 25 basis points or 50 basis points. So a lot of that is in the price. And I think you have to then look at the REIT fundamentals, because I guess the interest rate cycle we feel is already priced in. And those fundamentals may not be that great, particularly in the USA, where I think demand for office space is coming down significantly. There may be some growth still in South Africa, and they're filling some vacant space. So, but yeah, we think they're more market performance at these levels as rather exciting on a rotation play.
Gotcha. Yeah, and I take your point. I mean, the market saw this coming. Look, we thought rates were coming down in January, not we, others. Here we are in September, but it is finally starting to happen. Let's move to our stock picks. Rowan, Sun International, results were out last week. And I got to say, when I looked at them compared to City Lodge, I thought a lot better, a good set of numbers. And then, of course, two pots money coming, lower interest rates. You're liking Sun International?
Yeah, so I think a solid set of results with a lot more potential to come. As you say, the consumer environment is easing up, and where we expect the rate cut on Thursday. More money in consumers' pockets, so they're going to be spending more on leisure, gambling. And I guess what is the sort of X factor with Sun International is the SunBets business, where we're seeing exponential growth there as online betting just grows and grows in popularity. If you were watching the Olympics, and most of the adverts were about online gambling. So, and they have a very strong position there. So I think there were concerns that the core gambling business was going to be cannibalized, which to some extent it is, but they're protected because they have a strong asset there. So quite an exciting opportunity.
Okay, Sun International. And Willem, you're going with Adobe, results out late last week. One of the first software as a service businesses, a decade or so ago. Results might have been light, but software as a service, it has worked.
Yeah, that's a very, very fair comment. results beat on EPS and on guidance. They beat in the wrong shape. The market's looking for generative AI to perform in Adobe, which means sort of the share rallied into the results and came off sort of 8%, but it's still very strong sort of in a 2-month basis. The investment case there is it's a strong compound growth business. So the document cloud business, the digital media business, they grow at sort of 12 to 15% per year. And the catalyst would be generative AI coming in. So the valuation, especially past most recent results, which was only a quarterly result, is fair. The total yield from buybacks is sort of 5 to 6%. And in terms of exposure to the AI cycle, they are late, so they're sort of further down the stream, which means you sort of first have the tech, the investment in the tech, and then the investment in the software. So the catalyst still exists in sort of Adobe's numbers from that business stream.
Yeah, look, I've tried their Firefly. It's not bad, which is image generation. And apparently they've got a video product that will be launching fairly soon. That's all for tonight's Stockwatch. Thanks to our guests, Willem from Nitrogen Fund Managers, Rowan Williams, also from Nitrogen Fund Managers. Up next, the close. Stay tuned.